In this video, we are going to simulate what it is like to prepare a bank reconciliation in real life. A bank reconciliation is a report which compares the checking account balance listed in the company's accounting records against the balance of that same checking account according to the bank statement. To do this, an accountant would compare all of the activity reported on the bank statement against all the activity in the company's accounting records for that checking account for a specified period of time. Discrepancies between the two sets of records fall into one of two categories: errors and timing differences. Errors can be made by either the company or the bank and often are not discovered until the bank reconciliation report is prepared. Timing differences deal with transactions that have been recorded by the bank but not by the company, and vice versa. An example of a timing difference is an outstanding check. An outstanding check is a check that a company wrote and entered into its records that has not yet cleared the bank. This could be due to the fact that the check was written shortly before the date of the bank statement, or it could be because the recipient of the check just hasn't gotten around to cashing it yet. Another example of a timing difference is a deposit in transit. A deposit in transit is a deposit the company has made that does not appear on the bank statement. This is usually due to the deposit being made shortly before the date of the bank statement. Both outstanding checks and deposits in transit are examples of items that would appear in the company's records but not on the bank statement. There are also items that may appear on the bank statement but not in the company's records. Examples of these would include collections by the bank on the company's behalf, interest earned on the checking account balance, fees charged by the bank for services, and NSF checks received by the company. NSF is an acronym that stands for non-sufficient funds. If a company deposits a NSF check that it received from a customer, the company will think that those funds have been placed in its checking account and typically will not know that the check bounced until it receives the bank statement. Now that we've reviewed the purpose of a bank reconciliation as well as some of the related terminology, let's take a look at an example. Although the company from this example is fictitious, the process we are going to work through is going to be similar to what it is like in real life. We will see that in order to balance the checkbook, accountants need to look for and identify the differences between the bank statement and the company's accounting records. On Blackboard, you will find a document that corresponds to this video. Within this document, there is a story problem that I'm going to be working through today. I'd suggest getting this document out and working through the problem yourself as you watch the video. When you are done, there is another problem that you can try on your own to see if you can apply the concepts from the video. Now let's get started with the example. The narrative states that we are to use the following information to prepare the May 31st, 2011 bank reconciliation and related journal entries for Barney's Rubble Removal Service. The first thing we need to fill out on the reconciliation report is the heading. We can see once again from the narrative that this company's name is Barney's Rubble Removal Service. In the next line, we enter the name of the report, which is the bank reconciliation. And on the last line, we enter the date of the report. And we can recall from the narrative that we are balancing the checkbook as of May 31st, 2011. The next pieces of information that we're going to place on the report are the balances of the checking account according to the two sets of records. First, we will enter the current balance from the bank statement, which is $11,150. And then we will enter the May 31st balance according to the company records, which is $9,946. As you can see, there is quite a discrepancy in the account balance from the two sets of records. By completing this reconciliation form, we will prove why this difference exists. Now that we've listed out the balances, we are going to go through the two sets of records and look for any differences. We are going to start by looking at the deposits. In comparing the list of deposits and other credits on the bank statement against the detailed list of cash receipts in the company records, we can see that both sets of records contained a deposit of $1,200 on May 7th, as well as a deposit on May 20th in the amount of $3,400. However, the company's records show a deposit on May 29th of $290. This deposit does not appear on the bank statement. If you recall from earlier, a deposit the company has recorded in its records that does not appear in the bank statement is called a deposit in transit. That needs to go to our reconciliation form. Since this deposit was listed in the company's records, it is already included in the cash account balance listed on the bank reconciliation report. But since this deposit was not included on the bank statement, it is not reflected in the bank statement balance on the report. Since deposits always add to the amount of money in our checking accounts, we will always list deposits in transit as additions to the bank statement balance. If we look back to the two sets of records, there is one additional discrepancy between the company's list of cash receipts and the deposits listed on the bank statement. The bank statement lists $1,080 being credited to the account on May 21st. This credit does not appear in the company's records. Also, please note that there is a code labeled the letters CM next to this amount on the bank statement. CM stands for credit memo. In real life, the company's accountant would have to dig a little deeper to figure out what this credit memo was all about. In this problem, we can look to our supplemental information. The supplemental information informs us that the bank statement reveals that the bank collected a note and related interest on the company's behalf during the month. The principal of the note was $1,000 and the interest was $100. The bank also deducted a $20 fee for providing this service. If I take the $1,000 principal of the note, add the $100 of interest, and subtract the $20 fee, I get $1,080, which was the amount listed on the bank statement. Since the note collection was reflected on the bank statement, the bank balance on the report already includes this amount, but since the collection was not in the company's records, it is not reflected in the cash account balance. We need to add the net increase of $1,080 to the cash account balance on the report. I would also suggest providing the details of the principal, interest, and fee on the report. This will make the journal entries easier to create later on. Now that we've compared the deposits from the two sets of records, it is now time to move on to the checks and other disbursements. When we look at the checks and other disbursements, we start out by pulling the bank reconciliation report that was prepared at the end of the previous month. What we are looking for from this previous report are any outstanding checks that had not cleared the bank by the end of last month. It is possible that these checks could still be outstanding at the end of this month. On last month's report, we see two outstanding checks, numbers 101 and 102. If we look on the bank statement, we can see that check 102 is listed and the amount on the bank statement of $802 matches the amount from the report, but check number 101 is not listed on the bank statement and therefore is still outstanding. Outstanding check number 101 needs to be reported on the May 31st bank reconciliation report. Since check 101 is already reflected in the company's records, it is already included in its cash account balance. However, since this check has not yet cleared the bank statement balance does not yet reflect it. When the check does clear the bank, the company will have less money in its checking account. Therefore, outstanding checks are always deducted from the bank statement balance on a bank reconciliation report. Now it is time to start comparing the checks that were written by the company during the month of May against the list of checks and other debits listed on May's bank statement. Since we already accounted for check 102, which carried over as outstanding from last month, I have crossed it off so we don't need to look at it again. As you compare the checks in the two sets of records, make sure that you look at both the check number as well as the amount. If a check number appears in the company's records but not on the bank statement, we know that check is outstanding. If we see a check that appears in both sets of records but the amounts don't match, we know that we're dealing with an error and we'll have to investigate further. So working from the list of cash disbursements in the company's records, we can see that check 103 for $30 matches up with check 103 on the bank statement and we can cross it off. I am going to give you a moment to pause this video to see if you can find any outstanding checks, any errors, or any other discrepancies when comparing the two lists of disbursements. Alright, welcome back. As you can see on the screen, I have crossed off all of the checks where the check number and the amount matched in both sets of records. You will also see that I identified two outstanding checks, numbers 104 and number 110, which I highlighted in yellow. Remember that these checks are considered to be outstanding because they appear in the company's records but are not listed on the bank statement. Also, you may have noticed that check number 112, highlighted in green, appears in both sets of records but the amounts don't match, which indicate that there is an error with this check, which we will look into in a moment. Lastly, there are two line items that appear on the bank statement but not on the company's records, which I highlighted in blue. We will also need to look into these, but for now, we're going to place these two outstanding checks on the bank reconciliation report. Since checks 104 and 110 are outstanding and have not yet cleared the bank, they need to be deducted from the bank statement balance on the report, along with the other outstanding check we identified earlier. Now we are going to revisit the error we identified earlier dealing with check number 112, highlighted in green. We can see that the bank statement has the check listed at $210 while the company's records show the check at $120. In real life, the accountant would look into this discrepancy by looking at the canceled check to determine the correct amount. Canceled checks can be viewed in many cases by logging into your bank's website and viewing the image on screen, but in this problem, we are going to refer to the supplemental information. In reviewing the supplemental information, we see that in comparing the bank statement against the checks written during May, a discrepancy is discovered concerning check number 112 for telephone expense. The bank statement correctly lists the check at $210, while the accounting records show $120. From this information, we see that the bank correctly reported the amount of this check, but the company did not. Therefore, when we correct this error on the bank reconciliation report, we know that the correction has to be listed under the cash account balance since the cash account is currently reflecting the incorrect amount. Further, we know that the company incorrectly deducted $120 when it recorded this check previously, when it was supposed to deduct $210. In other words, the company did not deduct enough when it erroneously recorded this check. Therefore, we need to correct this error by deducting the difference between the correct amount and the incorrect amount. If we take 210 and subtract 120, we get a difference of $90. We need to deduct $90 from the cash account balance on the report. If we return to the bank statement, we can see the two line items highlighted in blue, which we identified earlier, that appear on the bank statement but were not listed in the company's accounting records. Each of these items has a code listed next to it on the bank statement: NSF, which stands for non-sufficient funds, and SC, which stands for service charge. We can now look to the supplemental information for additional details. We will focus on these two items one at a time. Starting with the NSF item, we see that the supplemental information states that a check received from a customer was NSF. The bank also charged a $25 NSF fee. We can see that the bank statement lists the NSF check as $154, which is the sum of $129 plus $25. Since this item appears on the bank statement but not in the company's records, we know that it needs to be listed on the bank reconciliation report. When the company deposited the NSF check it had received from its customer, the company would have assumed that the check was good and that those funds would be placed in its checking account. Therefore, the existing cash account balance listed on the report includes the $129 check that was deposited by the company. Since the company never got this money, and since the bank also charged a fee, we need to deduct a total of $154 from the cash account balance on the report. The final discrepancy we see between the bank statement and the accounting records is the $15 charge labeled with the code SC on the bank statement. The supplemental information provides us with the details on this charge. The bank statement reveals the bank charged a service fee of $15 for the month. Since this charge is listed on the bank statement but is not listed in the company's records, it is not yet reflected in the company's cash account balance and it needs to be deducted on the bank reconciliation report. Now that we have identified all of the differences between the two sets of records and have reflected these differences on the report, it is time to determine if we have proven the exact amount of the difference between the bank statement balance and the company's cash account balance. First, we will total all of the additions and subtractions related to the bank statement balance. I'm going to list these totals in the column to the right. Next, we take the bank statement balance of $11,150 and add the total additions of $290 and subtract the total deductions of $673 to get an adjusted balance of $10,767. We now follow a similar process with the cash account balance. First, we total all the additions and subtractions and place the amounts in the column to the right. And then we calculate the adjusted balance by taking the current cash account balance of $9,946, adding the total additions of $1,080, and subtracting the total deductions of $259 to arrive at an adjusted balance of $10,767. Since the adjusted balances from the two sides of the form match, we can breathe a sigh of relief. We have completed the report and have balanced the checkbook. After we have balanced the company's checkbook, we need to prepare some journal entries to get the cash account balance up to date. When making these journal entries, it helps to look at the bank reconciliation report. When we look at the report, we focus only on the adjustments to the cash account balance. These items reflect corrections of errors that the company made as well as transactions recorded by the bank, but not by the company as of yet. We will focus on these transactions one at a time. Our first adjustment is the $1,080 addition to the cash account balance. Since we are adding $1,080 to the cash account, we need to debit it for that amount. If we look at the notes that we placed on the report, we can see that the bank charged us $20 for providing the collection service. We debit collection expense for $20 to increase it. The description also reminds us that the bank was collecting a note on the company's behalf. Therefore, we need to decrease the notes receivable by the principal amount. We accomplish this by crediting it. We also know that the company earned $100 of interest. We credit the interest revenue account to increase it. The next adjustment we need to make to our cash account balance deals with the error that was made concerning check number 112. Since this error required us to deduct from the cash account balance, we need to credit cash in our journal entry. To determine the account that we need to debit, we need to refer to the supplemental information. The supplemental information regarding this error shows us that the check was written for telephone expense. We need to add $90 to the telephone expense account to correct it. This is accomplished by debiting it. Our next adjustment deals with the NSF check that the company received from its customer. Since this adjustment is listed as a deduction from the cash account balance, we need to credit cash in the journal entry to decrease it. We also need to show that the customer who gave the company this NSF check still owes the company since the funds were never transferred. we need to increase the accounts receivable account by debiting it. There is one more thing to note about this NSF check. The company is not going to recognize the NSF fee that was charged by the bank as an expense because the company is going to try to collect both the original amount of the check as well as the fee from the customer. This is why accounts receivable is increased by the full amount, including the fee. The last adjustment that we need to record relates to the bank service charge of $15. Since this item is deducted from the cash account balance, we need to credit cash to decrease it. We also need to increase an expense account to reflect the fact that the business has used the bank's services. Your instructor may give you some discretion in how you name this expense account. I'm going to use the name miscellaneous expense, and I'm going to debit it to increase it. As you saw from this video, preparing a bank reconciliation can be a time-consuming endeavor, but it is one of the concepts from this class that is really practical and can be applied in real life, regardless if you pursue a career in accounting.